Recent events in the banking sector has raised significant concerns about the quality of governance at banks in India. Good governance in the banking sector, whether it is public sector banks, private banks, or cooperative banks, does not exist despite distinguished and experienced members of the board of directors. Is there any bank with good governance in India? Why are banks in India plagued with missteps in governance, including poor asset quality and accounting fraud? Why aren't the board members asking the difficult and tough questions on governance? We delve into these and more in our podcast today with Mr. Hemindra Hazari. Mr. Hazari is a SEBI registered independent research analyst with over 30 years of experience in the Indian capital markets. He has specialized in banking, macroeconomy, and corporate financial analysis. As an independent analyst, Mr. Hazari was one of the first to caution about the impending asset quality and corporate governance problems in Indian private sector banks, and his critical analysis on some of the CEO's performance, for example at Yes Bank and Axis Bank, finally led to the banking regulator refusing an extension to their tenures. A warm welcome, Mr. Hazari, to the Fraudopedia podcast. Today, we'll talk about issues in the banking sector, a topic that you've written quite frequently. The banking sector today, whether it is public sector bank, private bank, cooperative banks, they're facing significant issues of governance, and the management and leadership at these banks appear to be quite brazen and act with impunity. What can be done to ensure that the C-suite and the leadership is held accountable for their misdeeds?
Firstly, thank you for inviting me to your podcast. You will find that invariably, when major misgovernance is detected, the stance of the independent directors and/or nominee directors is that they did not know, as the executive was not transparent with the board. Well, such a defense is untenable, as it is their job to ask probing questions and grill managements on their decision making. Furthermore, these directors are also members of critical subcommittees of the board, such as audit, risk, nomination, and remuneration committees. Now, these are very important subcommittees where issues and proposals are or should be discussed in greater detail, as this provides the directors with deep insights into the functioning of these organizations. Hence, when major lapses take place, directors have to be held accountable, and executive directors need to be fired and clawbacks undertaken on their remuneration. For independent, non-executive, and nominee directors, the regulator and the independent advisory companies which provide recommendations on how institutional shareholders should vote on resolutions should maintain a negative list of such directors, and they should be barred from being on the board of any regulated entity. It is only when the punishment is severe, with some sort of financial penalty, which could also damage their professional reputations, that one can bring about better accountability from board of directors.
Absolutely. I mean, I think Fraudopedia is trying to develop this negative list of directors. Time will tell whether any action is taken on them, because I think, as we both know, everyone knows who should be on that negative list of directors.
This is what I find very surprising, and this is where the entire ecosystem is to blame. Because if you notice, one of the major blow-ups in the Indian corporate sector was IL&FS.
Absolutely.
And you will be shocked to know that there was one Mr. Bhargava who was the Maruti chairman.
Correct.
And he was on the board IL&FS for some decades, not even a single decade, mind you. And he was the head of their risk management committee, which in any banking or leverage institution is a very, very important subcommittee of the board. Now, mind you, I noticed this from disclosures in the annual report, which clearly stated that the risk management committee had not met in the last 3 to 4 years. And he was the chairman of the risk management committee. But if you notice, nothing happened to him. See, Maruti, he continues to sit on the board of Maruti. He continues to be the Indian public spokesperson. So nothing happens. And this is the problem when your ecosystem not only ignores such things, but actually continues to reward such individuals. It tells you what your ecosystem that we are all part of. And it's a very sad commentary on the state of affairs, really.
Correct, correct. I think there was another case, I don't know if you saw, I think it was called Leel Electricals. It's a listed entity, and their audit committee had not met for years. But the minutes were fabricated, and committee members would sign off on the audit committee, even though they knew that they had never actually met. I mean, and this is a listed entity. I mean, the governance it's similar to, IFIN, where it is shocking that the audit committee had not met, but yet minutes were prepared and there were professionals on the board. The company secretary prepared the minutes and everybody signed and pocketed the audit fees.
This is what I'm saying, because the companies that I research are very large companies, and they have very prominent or so-called prominent individual as directors. And they have even more prominent institutional investors. After all, ILFS had some very premier names, global names as their investors, and with their own nominee directors on board. And yet, you see, this is the way they act. And a similar case was with the National Stock Exchange, where you had all the major banks had their nominee directors, and all it seems that they were doing at these meetings were sipping tea and going to sleep, it appears.
So, what can the regulator do? Can the RBI, they've been vigilant at least on asset quality and loan provisioning. Can and should the banking regulator do more, take the lead in promoting good governance at banks?
You see, the Reserve Bank of India has taken cognizance of this issue and has implemented many board measures to ensure the independence of critical subcommittees of the board, such as the Audit Committee, Risk Management Committee, and Nomination and Remuneration Committees. Now, certain key management personnel in risk and assurance functions have been given independent reporting directly to the board. That means even for their performance and appraisal reviews, which bypasses the CEO. Unfortunately, the issue is not of competence and or of a reporting authority. See, the RBI needs to penalize senior bank executives, either demanding their removal, and in cases of serious lapses, the RBI should ensure that such individuals are not employed in any regulated entity. That is what is very important. Because invariably you find, even when these executives are removed, the competitor companies hire them in very senior position. So again, it tells you a lot about the ecosystem, that what exactly companies are looking for, the attributes they're looking for in individuals when they hire in senior capacities. Now, another what the RBI can do, and which they have deliberately not done so far, is that labor unions and officer associations need to be encouraged by the government and the regulators. Now, deliberately, the government and the RBI have not insisted on the forming of these unions and associations by the private sector banks. It is on account of this deliberate absence that pay levels and working conditions are so poor at lower levels in private sector banks. And this is seen by the very high attrition levels. It's around 25% in large private sector banks in FY 2024, which only lately the RBI has been addressing. Now, in many instances, labor unions highlight the lapses in senior management, but they are totally non existent in private sector banks. Now, recently, you'll be aware of a Union Bank case where it was highlighted by the union representative because they have access to all this information. Now, another issue which needs to be debated is whether former senior RBI executives should be joining the boards of entities which are regulated by the RBI. We have seen many instances where there are retired RBI executives on private sector bank boards. And currently, the chairman of Yes Bank and Axis banks are former RBI deputy governors. Now, the issue is this: senior executives at RBI, they do a supervisory role in banking. And this may be compromised if they're going to seek and accept directorships in private sector banks once they retire. While there are advantages in having the experience and expertise of former regulators on the board, the issue of executives being compromised while in service needs to be discussed and debated. Because I've come to know that some of these directorships and even the chairmen, they get very large perquisites, uh, which which may compromise the role when they were earlier serving as the when the regulator, because they'll be looking forward for some post retirement benefits. So this is an issue, I think, which needs to be discussed in the public domain on whether former regulatory executives should join regulated entities.
So you're recommending some kind of a cooling off period or a complete ban?
See, I think there should be today. I think there is a 1 year cooling off period, but that 1 year, I don't think, and sometimes even that 1 year, is compromised if you get the required approvals. Right. So I think you should have a much lengthier period. See, because if you have been in service, you already will be entitled to your pension. Absolutely. Right? Most of these, so it's not that you are going to be left without any income. Or there should be a rule that you can accept directorships, but not in any regulated entities. I think that will be more viable. Correct. And they are required by these people because they want to use their contacts who are their juniors in the regulator to get some benefits that that particular bank should enjoy. That is really the real case why they want them. Correct, they bring about some expertise, that there is no doubt, but I think that is the more important reason, is to get some more benefits, because banking is such a heavily regulated industry, and rightly so. So they want to see where some compromises can be made.
So what about then SEBI's oversight of listed banks? Because we see the issues in IndusInd Bank, Yes Bank, Axis Bank, all they're listed. So SEBI equally has jurisdiction over these banks. Can SEBI do more, and should they be more proactive in weeding out bad banks?
Issue is here in listed banks, the RBI is the primary regulator. But where it involves complying with the listing requirements, SEBI is the regulator. Now, I've noticed this, that when it comes to banks or any companies regulated by RBI is the primary regulator, SEBI really only involves itself, and rightly so, only with the listing agreement, because they can't venture beyond that, because then they will be encroaching on the RBI stuff. Now, here again, I would like to again re-emphasize that penalties have to be severe for major lapses. Unfortunately, monetary penalties are treated by errant regulated entities as part of their cost of operations. See, the penalty should not only recover all the monetary value of all that what the entity should not have been doing, but on top of that, that should be a severe penalty. Invariably, what happens is that the penalty is just a fraction of the gains that they have made by undergoing that illegal activity, which actually become just a part of the cost of operations. And that is why such penalties have to be extremely severe, so that a lesson is taught to these entities and to the senior executives. Because invariably, I find the senior executives get away. It's only the shareholders who pay that penalty, because it is just a expense item in the profit and loss account. So until you do not penalize them severely, such kind of activities will continue.
So what about then rating agencies? I think recently, even rating agencies have failed to detect lapses in governance, and they review the ratings post at the event of default. That serves no one's purpose. I would have thought that the rating agency should have had some kind of a warning sign or downgrade a debt or the company itself. But what is the point of downgrading after an event of default has occurred?
The role of credit rating agencies is to try to predict a future default. That is the role. That is what they function. That is their sole responsibility, right? or to give a probability of default. Now, when you have A rated companies defaulting, then there is a severe problem with the credit rating agencies. And I have been pointing this out that even in the case of ILFS, it was nearly AAA, it was downgraded to AA and then promptly defaulted. Or even in a recent case, you'd find that it was an A rated company and then it defaulted. And when it defaults, the official explanations that the credit rating agency gives is that the company did not inform them of any problems happening. Now, that is not, if you're going to be a kind of a stenographer and you have to be told what is going to happen, then sorry, the capital markets or the public does not need your services, right? And invariably, I have found in such cases that when you do an analysis, you can clearly see the deterioration in the financials, in the information in the public domain. That is, and credit rating agencies, as part of their rating, they have access to non-public information on a regular monthly basis. Now, if as an analyst, I can show that you can detect the problem much earlier from published information, and your rating upgrades, downgrades, which you normally do, is not in factoring any of these factors. That means you're totally ignoring this deterioration, then you have no reason to exist as a credit rating agency, because that means there's something fundamentally wrong in your methodology and the way that you work, and therefore in such cases their license must be revoked.
See, I mean, I hear very often that everybody relies on financial statements that are audited. So somehow there is a stamp of approval just because financial statements are audited. And that is far from the truth. Just because the financial statements are audited, that does not mean that they're true and fair. You found actually routinely frauds which have been hidden, concealed, with management, without, not detected by the auditors. So this reliance on financial statements which are audited and discussions with management to arrive at a rating which doesn't really fit borrower seems to be the norm. So, but in conclusion, I just wanted to get your thoughts on who's going to bell the cat on good governance and ethics. I mean, beyond compliance, beyond just complying with checklists and tick the box.
See, banks are special as they play a very critical role in the economy as an intermediary between savers and borrowers, and also as a vital role in the payment system. Now, to protect the depositors and public at large, we have institutions such as regulators, RBI, SEBI, statutory auditors, credit rating agencies, the media, stock market analysts, investor advisory companies, labor unions, and whistleblowers. Now, institutions such as the business media and analysts unfortunately have preferred to align their interests with that of the executive management in companies, especially the large private sector banks. The role of the business media, credit rating agencies, and my own community of analysts has been particularly disappointing. Again, the reason for this is because their business model entails working very closely with the senior executive management of the banks. Now, contrarian views need to be encouraged, and entities such as the media, credit rating analysts need to be more adversarial rather than being compliant. The institution of whistleblowing should be strengthened, as in many cases, the whistleblower has been the first to report on the irregularity. However, in India, companies crack down heavily on whistleblowing, and invariably the whistleblower is sacked on grounds of poor work performance. Moreover, once a whistleblower tag is attached to an executive, no company will hire that individual, as in practice, the corporate sector does not appreciate or tolerate whistleblowing. Hence, it is extremely important that whistleblowers are protected and encouraged not only by the regulators but also by the board of directors. So, in sum and substance, the government and the regulatory agencies need to protect those who are designed to provide an adversarial role in the system. Unfortunately, those institutions which are designed for this adversarial role have become severely compromised. And that is why you find that there will be, there are a lot of these scams exploding all the time and of such large sizes. Because when we could have nipped them in the bud, right, through either proper auditing or whistleblowing, all these institutions have been effectively compromised, and that is why they don't come out at an early stage. And you can see in IndusInd Bank, for example, now the management itself admits that's been going on for 6 to 7 years. Now, why is it that in the second or third year no one realized this was going on? So that means the entire system has got compromised.
Correct. So now that it's come out, it was initially blamed on some RBI rule, which wasn't even the case. And now it's all just blame game. Each, the market participants are just blaming each other. We're not sure what, the story is still to be written on who's going to be held accountable, because the auditors also don't know if it is a fraud, because they've asked the management again, which is this committee. The former management doesn't exist. They just want a written statement that it's concluded as a fraud.
And interestingly, the people most directly involved have sold and have made their money and have gotten away. Now it seems that SEBI is probing them, but they have made their money by selling the stock at a very high price. Correct. And all the other shareholders now are looking at this depressed share price.
Correct.
See, that is the tragedy, because you could not punish these people at the appropriate time.
Correct. No, retail investors are always left holding the losses in the bag when everybody else, initially SEBI said they had no evidence of insider trading. Now they're probing 6 or 7 people for insider trading. And I'm sure there are more than 6, because they were insiders. They were aware of this. But let's see. We conclude this podcast and thank Mr. Hazari for sharing his insights and time with us. We hope that you find this podcast meaningful and interesting. See you next month.